There's lots to like in Lloyds Banking Group's first quarter results. Costs are down and should keep falling, and profits are up. Lloyds has also reaffirmed targets for 2019, expect net interest margin steady at 2.9%, capital build of between 170 and 200 basis points per year, operating costs below 8 billion and return on tangible equity of 14 to 15%. However, the market's initial response has been negative, reversing yesterday's 1.7% gain. A 2% increase in revenue was less than expected, and both profit and measure of balance sheet strength were a little light. Concerns around Brexit and the competitive mortgage market remain also. Investors may also have done their buying yesterday when regulators deemed Lloyds safe enough to reduce its systemic risk buffer. That was a big positive, and Lloyds could use the excess capital this releases for share buybacks, a bigger dividend, or both at year end. Net interest margin is a closely watched metric in the banking sector. It measures the difference between what Lloyds charges on money it lends and what it pays to savers. In Q1 it dipped to 2.91% from 2.93% a year ago and from 2.92% in Q4, but that's in line with expectations. Adjusted pre-tax profit tells us how much money Lloyds makes, ignoring so-called one-off items like restructuring and branch closures. This and cash flow are hugely important in determining the level of the dividend. It jumped 8% year on year in Q1 to 2.17 billion and is up 22% on the previous quarter, but adjusting for insurance gains means a small miss. Common Equity Tier 1 ratio, or CET1, is a key measure of capital strength. Banks must achieve a CET1 that demonstrates an ability to survive another financial crisis. Any excess above target implies more money for shareholder returns. Q1 saw a 20 basis point dip to 13.9%. The City wanted 14.1%. In summary, Lloyds has a sound balance sheet, carries less risk, can afford an attractive dividend and trades on a price-earnings ratio of 8 and less than 1.2 times tangible net asset value. But competition among lenders is fierce. Banking's a cyclical business, and a downturn in the economy would reduce lending and increase the risk of bad debts. Banks prefer high interest rates, not low ones, and there's always the risk that other legacy mis-selling issues may emerge.